All right, we're going to use the commercial real estate marketplace and the tremendous down cycle that that commercial real estate is in right now. We're going to use it to offer us some teaching moments on a few different things. And so there's one central concept that I definitely want to get across, which is whenever there is a down cycle that everybody knows about, it's just everybody knows about this down cycle, that commercial real estate is in deep trouble, that there's going to be a real reckoning coming, if not a crash, right? I would say this is a widely held consensus view. And when that happens, you want to perk up, right? You want to be thinking the other way, leaning the other way. And, I don't know what stocks in this space to buy or what the timing would be at all. But what I would do here is I would start building a list of ticker symbols that I might consider in the future. And I would start with some primary bellwethers. So, I'm not saying anything bullish or bearish about this particular company, except that it is a bellwether and it should go on that list as something to just track and to give you context for this space. And, Vornado, basically, it's a pretty well-regarded company. It has some trophy properties, both established and in development in the New York City metro area. So it's kind of a New York City levered commercial real estate REIT. Now, that might be bullish or bearish, right, depending on your perspective, but that's the backdrop. And just following the video we did prior to this one, video 137, where I talked about what do I do when I want to get up to speed on an industry or a company that I don't know well. Well, I start reading their company transcripts, right? And so these are the steps that I'll take when there is a down cycle happening, and up cycles almost inevitably will follow down cycles, right? So you kind of want to start thinking about what tickers to consider, build a list of them, and start reading, skimming some transcripts, right? So that's step one to kind of get ready when there's universal consensus that this industry is in deep trouble. Okay, now, I also want to talk about different things to think about in terms of the capital structure. Now, we've done other videos on preferred stocks, and you can find on video 121 and video 132, we've talked about different nuances and idiosyncrasies with preferreds. Now, it's interesting, if you go to Vornado's website and pull up their 10K, and all you have to do here is just do Control F, put in the word preferred, and it'll take you to basically here's just a little handy chart of the different preferreds that this company has. Now we see here there's a Series A convertible preferred, so that would be convertible into common stock, but there's not very much of this left, so this is probably, we wouldn't be taking so much of a look at this, but we can see here there's four different the Series L, M, N, and O preferreds that sit on this company's capital structure. And you can see here the coupons are not that good. Obviously, these were issued before the recent significant hike in interest rates that happened over the past year or so. So good for them. They've got good paper in terms of from their standpoint, but it might not be that attractive from our standpoint. But with the nuance that if we pull up, let's take a look, for example, at the Series L, pull up a chart of it, and by the way, note the nomenclature here that Seeking Alpha uses. VNO.PL is the nomenclature for the L Series preferred, 5.4%, right? Some brokers and some sites will use the nomenclature VNO and then a plus sign and then L, but this is the particular nomenclature here. All right, so the nuance, though, is this thing is trading at 13. Remember, par for a preferred is 25. So this thing is almost half off, and it gives you an indication of the level of pessimism. Remember, the preferred is rates higher in the list of creditors as the common stock. It's one step above common stock, so it's low on the list, but when you have a preferred trading at half of par, this is could potentially pretty binary. It indicates significant pessimism about this company. In fact, even when we had the COVID crash, this preferred only got down to 18 something, right? It went from par to about 18 during the bottom of the COVID crash in 2020. So now there's much more pessimism today than there was even at the peak of the pandemic response period. Now, the nuance, of course, is 5.4% coupon paper trading at half off yields much more, right? The actual effective yield is 10% when you have this paper that you can buy at 13 when par is 25. So I just point this out to give kind of a different perspective, because the preferreds can often be thought of as quote unquote smarter than the common stock. Now, just to argue the other side of this argument, if you really are bullish about this company, if you really think that there's going to be a recovery and that this company is going to participate, you wouldn't buy the preferred, or you wouldn't put most of your capital into the preferred. You would buy the common stock, right? Because the common stock has uncapped upside. And also this company theoretically could pay dividends. There could be a growth rate to that dividend. And so you could have significantly higher returns by just owning the common stock. Just the preferred will give you different contours of returns, because you can, if things work out here, you have upside to 25, right? You would get par if this company fully recovered. Plus, you'd get these coupon payments with an effective yield of 10% on your initial investment here, buying it at 13. So these are just different types of paper that you can buy in a company's capital structure. And it's just worth thinking about these other preferreds, because they give some indication of pessimism or optimism about the company, and it helps kind of back up or corroborate your thoughts on the common, right? Now, there's one more thing I want to talk about, which is actually kind of hilarious. So here's a related company in the hospitality space. Park Hotels is a hotel REIT, and this company did something sort of interesting just a few days ago. They have two major hotels in San Francisco, and there's a loan, $725 million loan, which is collateralized by these hotels. And this REIT decided to just stop making payments on this loan and basically mail the keys to these hotels to the lenders. It's kind of analogous to what a lot of homeowners did during the Great Financial Crisis, right? You can't make your mortgage payment, just mail the keys, jingle mail the keys right back to the lender, and now it's the bank's problem, right? And this company, so therefore, they actually accomplished two things, right? They now no longer need to make these payments or repay this loan. And furthermore, the properties are no longer on their balance sheet, right? They're on the bank's balance sheet, because the bank takes over if you can't make good on the loan. Now, the nuance here is the loans on these hotels were non-recourse loans. And that is an important nuance. And I'll lay a few breadcrumbs about Vornado, because Vornado actually has a fair amount of non-recourse debt on its balance sheet. Now, what's non-recourse debt? Basically, you can have a loan that is collateralized by a property, and the lender does not have the ability to go above that property to get made whole. So some loans have recourse to the corporate level or to the full company level. Other loans may only have recourse at the property level. And so in the case of a non-recourse loan, this Park Hotels company was able to just give the property back to the bank or stop making payments, and it didn't actually threaten the overall company. Obviously, it's bearish, but it isn't existentially threatening to the company. And in fact, why I said this is hilarious was when this news came out, the day it happened, this particular stock traded up 2% on the news. And that's because there's a significant liability that is now no longer a running problem for this company. And maybe it's bullish to get a couple of San Francisco hotels off your books, right? So this is another nuance to think about the capital structure of a company and to what extent the debt, and remember, commercial REITs tend to be debt layered with different types of debt, and they tend to use quite a bit of leverage. And so this is a type of problem or solution to this space where companies may be able to jingle mail certain properties back. They may be able to adjust their portfolio through capital decisions like this. And that is something, obviously, you have to do a lot of due diligence on a given company to sort of see the lay of the land with their debt structure. But if you get it right, a company can actually make it through this down cycle and, again, be ready for the inevitable upcycle that's going to happen. So a few different ideas here, but basically the three things. We're talking about when there's a universally understood down cycle, to start to lean the other way, right? To start thinking about what you might invest in, what tickers to keep an eye on. Secondly, to look at different places in the company's capital structure. And this is where we talked about Vornado's L-Series preferred or some of the other preferreds that they have. And then third, to look at this non-recourse debt situation that Park Hotels did, and maybe we'll see other repeats of this, or it's a type of indicator to give an idea of what is the nature of the existential risk to a company. Maybe it's less than we think, right? And there are some definite clues that Vornado management gave us in their most recent conference call transcript about this issue. So again, worth reading the transcript and maybe worth starting to take a serious look at the space. But again, I don't know when the recovery would come and which tickers to look at. So just a big caveat there. But this is how you think about cycles, and this is how you think about different companies during a down cycle. All right, as always, thanks for watching.